After more than 10 years as a financial advisor, I've seen some terrible advice given to high income earners, the kind that can leave millions of dollars on the table. So today I want to walk through research-backed strategies for each income level, whether you're a business owner or a T4 employee here in Canada. We're going to start with $250,000 of income and work our way up to $1 million plus, introducing 3 strategies for each level of wealth that you can employ to optimize your investing and wealth management potential in Canada. However, other countries typically have similar optimizations available. When you hit $250,000 of income, this is what I call a dangerous level of income. You're earning more than a lot of your friends and peers, but you're not in the place yet where you can afford to be careless with your money. The smartest people do a few things really well, and I'm going to walk you through them now. Number 1 is they automate everything. Every decision you make takes some form of mental energy. Every manual, should I invest this month, decision is a chance for fear, greed, or procrastination to intervene. An excellent book was written on this subject by David Bach called The Automatic Millionaire. I recommend everyone read this book if you struggle or want to improve your investing habits. The second thing you need to do at this stage is have a registered plan contribution schedule and contribute to both TFSAs and RRSPs automatically. TFSAs, RSPs, and group sponsored pension plans should be taken advantage of fully in most cases. These registered plans open up around $40,000 a year in savings rooms to tax sheltered accounts. At a $250,000 income level, you're bringing home around $155,000 in after-tax income. If you maxed out your registered plans, you'd be saving around 25% of your income, which should be doable. And if it's not, you need to look at your cash flow to understand where all your money is going. As an example, if you go to my website and click on the RSP calculator, you can see that at $250,000 of income, a $32,000 RSP contribution will generate you nearly 50% back in tax savings. Because you'll most likely be in a lower tax bracket at retirement, this is a way for you to save money tax deferred and play a game I call income tax bracket shifting. You're deferring a portion of your salary in a high tax year into a low tax year. The third thing you need to realize is that making the right investment decisions with the money you are saving is absolutely critical. At this stage, many people can start to feel overconfident. You're getting to a place at your career where you're probably spending more time thinking about investment options, and you have more money to invest, and you may think that you know where the market is going, so you can buy or sell stocks and make a quick profit. You may also be tempted to start thinking you need to add complexity in your life and invest in uncorrelated asset classes like private equity or alternatives. The financial industry does a fantastic job of marketing these products to people like consumers and financial advisors, telling us that we need to be selling this to our clients. But here's the reality. Most of that is marketing. At a $250,000 income, you can't be reckless. You need the money to be there at retirement, but you also don't need what these fancy alternative products are selling, which sounds like protection from volatility and preservation of your principal. While that's the pitch, it's rarely the result. And here's what we know. Complexity profits the financial institution and product makers more than the end investor. And most active stock pickers trail the market, including professionals, in investing in a low-cost index fund that is diversified across sectors and across countries is still the best for investors who want to DIY. In a paper by Barber and Odin in 2000, they discovered that most active traders trailed the market. In a back-tested study done by Bessenbender, he found that from 1926 to 2016, only 42.6% of stocks actually beat treasury bills. That's like trying to find a needle in the haystack. Trying to find the needle in the haystack by buying specific stocks is an exercise in futility. Instead, just buy the haystack. The haystack is index funds. There are some great one-decision ETFs in Canada you can buy on Wealthsimple. Things like VEQT or XEQT are ultra-sophisticated low-cost portfolios that auto-rebalance your investments. If these were available in the 90s or 2000s, they would have been reserved for the ultra-high net worth individuals. Now, they're available for everyone. At this stage, determining whether you need a financial advisor comes down to complexity. If you're in a government job with a defined benefit pension plan, all you really need to do is be diligent in investing and let the one decision ETFs do the heavy lifting. You may need to seek out advice for one-off decisions, but really you are set up well. Now, if you are compensated via stock options or RSUs, or your company has an IPO and you need to know how to handle a windfall, then you may need to seek out ongoing financial advice and behavioral coaching. Lacking the right behavior or knowledge can cripple your wealth journey regardless of your income level. When clients come to me around the $500,000 income level, I typically find 3 things right off the bat to improve the management of their investing and wealth management. In most situations, lifestyle inflation has slammed them, They have a poor tax strategy, and they're battling something we call status quo bias, which is an absolute wealth killer, and I'll explain it in a minute. Let's start with the first of these three problems, lifestyle inflation. Lifestyle inflation can happen at any level. I was recently working with a client who had over $500,000 in take-home after-tax pay, and they were only running an $8,000 a year surplus. $8,000 a year on $500,000 of net take-home pay is not spending too much money on shopping. That's simply making bad financial choices. Often there's pressure at this income level to spend money that you have. It pushes people into the realm of private school for $50,000 a year, the country club for $18,000, driving 2 luxury vehicles, buying the $2.5 million house plus a rental property because someone told them that's what wealthy people do. In reality, making $500,000 means you're only keeping roughly $272,000 in Ontario. Almost half of your income is gone to taxes. So if you don't have strong financial habits leading into this income bracket, you're going to be in the same situation you were when you made $150,000 and $300,000, left wondering where the heck all your money went. So here's what you need to do at this stage. Implement Toyota's lean method for your business or your personal life. Toyota ruthlessly identifies waste and is quick to cut it. They never overspend and ensure quality is the lead measure rather than assessing it after the fact. They do this with 2 pillars, just in time, meaning produce only what is needed in the amount needed, and Jidoka, which is intelligent automation, building quality into the process rather than expecting it for quality post-production. So how does this apply to your personal life? Well, first you need to build your own 2 pillars. Here's how I apply Toyota's pillars into my life and what I advise clients to do. The first pillar, the just-in-time pillar. This is cash flow precision. This is you not wasting your dollars. Just because you are earning more does not mean every dollar is now worth less. An example of this is to be intentional with your cash on hand and your spending habits. Many people keep way too much cash on hand at this income level, doing absolutely nothing for them. You need to build in rules to your financial life. Simple, easy to follow rules. Here are some examples of rules that you can follow. Rule number 1, determine my emergency fund number and do not keep $1 more of cash on hand. The rest must be invested or used to pay down debt. Rule number 2, complete a financial audit every 3 months. Cut what I don't need anymore. Rule number 3, every month I have a discussion with my partner around the next month's spending. Our dollars are allocated, our surplus is identified, and there is an action plan for that surplus before the money ever hits our accounts. These simple rules will help you master control of your cash flow. The second pillar is Jidoka, automatic quality controls built into your financial life. This is like a financial safeguard that stops problems before they come up. Again, rules here are necessary and easy to understand. Rule number 1, automate your investing so that you save a minimum of 10% of your take-home pay every single month. No decisions needed after implementation. Rule number 2, any purchase over $5,000 requires a 48-hour cooling off period. Rule number 3, talk with a neutral third party, which is what I am to my clients, before you make any commitment to long-term financial decisions. These rules are a great place to start to avoid lifestyle creep coming into your life at a $500,000 income. The second mistake I see is people at this level having no tax strategy. At a $500,000 income level, so many doors open up for you outside of just RSPs and TFSAs. You can take advantage of income splitting through spousal loans. You can front-end load RSPs to split income with your kids when they turn 18. You can use spousal RSPs strategically. You can implement cash damming strategies with rental properties. Yet so many times when I meet people at this income level and ask them about tax planning, they tell me that they have never done it. If you're not having people comb through your tax returns to find every available deduction and not having people set you up for the next 10 to 20 years so that you're paying the least amount of tax possible, then you're doing yourself a disservice. Yes, this advice costs money, but it saves you so much time and money in the process. For one client, we were able to find massive tax savings through strategic liquidation of stock options over a 10-year window. For another, we were able to fund his wife's business through contributions to a spousal RSP. And 3 years later, his wife was able to take the money out, pay almost no tax on it, and start a business. Meanwhile, he got a 53% tax savings for contributing to the spousal RSP. Look, there's so many strategies available to you, but you need a tax plan and a financial plan to optimize it. The third mistake I see is indecision. The number one reason clients come to me for advice, and I've actually analyzed over 500 calls to come to this conclusion, is that they are now at a place where mistakes can cost them tens of thousands of dollars today and hundreds of thousands in lost opportunity costs. And they just need to make sure they get it right. Fear is a powerful motivator. Yes, self-directed portfolios invested in low-cost index funds are great when you have 100,000 invested. But when that number jumps to $1 million and the market corrects, like we saw in 2022 by nearly 30%, that $300,000 loss starts to look awfully scary. And this can lead people to making irrational decisions, and something that has been identified in behavioral finance called status quo bias. In 1988, researchers Samuels and Zeckhauser came out with a study called status quo bias in decision making and found that people overwhelmingly stick with doing nothing even when it costs them. In 2000, Iyengar, Huberman, and Jiang studied nearly 800,000 retirement savers and found that with every 10 new fund choices added to 401k plans, participation in the plans dropped by up to 2%. Indecision, especially given all the choices we have now for investments, I mean, we've got more ETFs than stocks now, is going to crush your wealth creation journey. Even though you are paying for advice when you go to a financial planner and wealth manager like us, what you're getting in return is well-researched portfolios. You're ditching indecision and status quo bias. You are getting help in the areas of your finances that you need the most. And you are handing this over to people who do it for a living. Now, before I move on to the last phase, the $1 million earner, I want to touch on financial planners who I mentioned above. If you are going to reach out to someone, not every financial planner is equal. In Canada, the CFP is the gold standard, but even then, it may not be enough for you to be sure that the person you are considering working with is actually working in your best interest. That's why our advisors are FPAC members. We have taken fiduciary pledges to only act in the best interests of our clients. If you're seeking financial advice in Canada, do the following. Make sure your advisor is licensed appropriately. That's the baseline. It will look like this. Make sure they are CFP professionals in good standing, and make sure they are members of the Financial Planning Association of Canada. Now on to the last section. What to do with $1 million a year in income. Everything I have just mentioned for a $500,000 earner is just as true for a $1 million earner. However, the stakes are higher. Even if you haven't reached this milestone yet, the strategies I'm about to show you may save you in the future if you do reach this threshold. If you're earning $1 million, things change in a meaningful way. Generally, people in this income bracket are over-concentrated in their portfolios and have more complex tax structures to take advantage of, like trusts. Let's start with over-concentration. First off, if you're in this income bracket, you are likely either a business owner or an executive in a public company with massive amounts of stock compensation. This means two things. One, your career is likely high risk, and two, your investments are probably over-concentrated in your company's stock. More than anything else, your human capital is your most valuable asset. That means that when you look at managing your money, you need to look at it as a holistic perspective of your human capital plus your investment capital. Your human capital is the present value of your future earnings or your earnings potential, and your investment capital is your assets. Ask yourself this question. Let's say you work for a publicly traded company in tech. If tomorrow the tech sector took a big hit and you lost your job due to layoffs, would your portfolio also follow? If the answer is yes, you are over-concentrated in your human and investment capital. University of Toronto professor Moshe Milevsky has a book called Are You a Stock or Are You a Bond? In that book, he compares your career to that of a stock or a bond and encourages you to build a portfolio that hedges the risk of your human capital. So in my example above, a tech executive in a public company, your career is like a stock. It's highly compensated, but also high risk. Therefore, you should be more conservative in your investment portfolio and let your earnings and savings capacity offset the lower returns you might see. Now, big caveat here, this does not mean you should be out of the stock market. It just means that instead of investing in your company's stock as well as the NASDAQ while working at a public company in tech, you'd be well served to diversify out of tech altogether. On top of maxing out your registered plans, you should also be looking at more advanced strategies. Trust setup to preserve control of wealth to the next generation, strategic philanthropy, which is using your appreciated stock portfolio with unrealized capital gains as your donation bucket instead of cash, giving you huge tax advantages of getting the full tax credit on the donation, but also not paying tax at all on the embedded capital gain are just a couple of those strategies. But there's always catches here, like alternative minimum taxes, which I will explain in another video, so be sure to subscribe for that. Always get professional advice from knowledgeable tax and financial professionals before enacting any strategies you see online. Now, if you're a business owner, you need to look at a few things here too. On top of that asset allocation strategy of being more conservative, the more high risk your career is, You also need to consider setting up a family trust to multiply the capital gains exemption to family members. I recently helped a business owner set up his company so that if he sold it, he could sell for up to $5 million completely tax-free using a corporate structure that had the shares that he owned roll into a family trust where him, his wife, and his 2 kids were beneficiaries. Now, instead of just him accessing the lifetime capital gains exemption, which is capped at $1.25 million, all 4 of them could do it. Because this income level has so much variation to it, it is difficult to capture all the strategies in one video. At Mill & Wealth Advisors, we do hours of analysis on each client to determine what the right strategies are. But these basic principles listed above are still beneficial to think about on your own. Look, whether you are earning $250,000 or $1 million, the takeaway is the same. You have to invest in your future. These income levels rarely last forever. Burnout catches up, priorities shift, and eventually, most people want to step back after years of grinding to get to the top. Make sure you do the research and acquire the knowledge, or work with trusted professionals who have it to maximize your long-term wealth.